Recently, Bitcoin has been dropping while the Japanese yen has been surging. Have you ever wondered why these two things happened at the same time? From my perspective, the reason boils down to just two main factors. First, the Bank of Japan, BOJ, directly mentioned that it could raise interest rates. Second, the US Federal Reserve started actively checking the currency markets. This is called a rate check. Why is rate check so important? Why this is so important? It means the Fed is not just watching the markets. They are signaling that if the currency market gets too volatile, they might step in to stabilize it. In fact, they've been asking major dealers like JP Morgan about bid, ask spreads, and other actual trading conditions. This isn't just talk. It's a more like signal. The currency intervention could be right around the corner. And when these two signals, the BOJ hinting at a rate hike and the Fed rate check, overlap each other, the yen strengthens very quickly. So here's a question. Who gets hurt first when the yen suddenly jumps? The answer is investors. Investors who borrow the yen to invest. What we call yen carry trade investors. For decades, the yen has had very low interest rates, so investors worldwide can borrow yen to invest in foreign stock, gold, or Bitcoin. But if the yen strengthens, these investors are hit first. Holding their borrowed yen costs them more. So the first thing they do is to sell the most liquid asset. That's usually Bitcoin. As a result, roughly $700 million in leveraged position got liquidated at once. Yen carry trade investors pulled out and Bitcoin prices fell, triggering liquidations which caused even more selling, a classic cascade or chain liquidation. But that's not the end. Another key variable is the Fed and global policy. Right now, the US is negotiating with major US export partners, Japan, South Korea, and Taiwan. The goal is to weaken the dollars and strengthen other currencies. And you might think, why? Why would they deliberately weaken their own currency? There are actually three reasons. First, weakening the dollar boosts US export competitiveness. Two, it stimulates economic growth through increased exports, investment, and employment. And three, the most powerful reason, it stabilizes financial asset markets. In fact, looking back, after 4 previous rate checks, including during the 2008 financial crisis, markets first stabilized and then generally moved upward. So Fed intervention is actually a factor that strengthens the downside, supporting the market. Now, what happens after short-term adjustment in gold, silver, and Bitcoin? Gold has reached an all-time high of $5,100, and silver is at its highest ever premium due to supply shortages. This shows that capital is moving to avoid currency risk. Meanwhile, the Bitcoin remains a long-term undervalued hedge asset. Institutional investors like MicroStrategy continue to buy it, adding $2.1 billion during this price dip. So the recent Bitcoin adjustment is not caused by problems in cryptocurrency itself. It's a result of combined macroeconomic factors. Government shutdown risks, geopolitical tensions, and potential yen intervention. Among these, the core variables are clearly the yen and Fed. So, in summary, focus on the long term. Don't be shaken by short-term volatility. Watch the Fed's moves carefully and look for appropriate correction periods strategically.